retirement savings plans, such as RRSP. So RSP are registered retirement savings plans. This is an account that holds your savings and investment assets. It is a great way to save for retirement and to cut your tax bill. So with an RSP, you can do several things. These are the benefits of RSP. First of all, you can buy your first house with the RSP home buyers plan. You can coordinate your RSP strategy with home purchase. So currently, the person who puts the money in RSP and their spouse can borrow $35,000 each from their RSP. So as a spouse, they can take up to $70,000 from their RSP to buy a house. For example, Melissa wants to buy a house in 5 years. She plans to save $20,000 for a down payment by putting away $300 a month. If Melissa was to put this money into an RSP, assuming she has a contribution room, she would get, number one, a 30% tax saving based on her marginal tax rate, which equals a tax refund of $1,080 per year. In 5 years, she will have $20,000 in her RSP to borrow when purchasing and an extra $6,000 from the tax saving. So in this way, this is beneficial for her, and it's easier to save up the money in the RSP than the after-tax money. RSP withdrawals. So if you're taking money out for home buyer plan, like we said, $35,000 per spouse. So it is for couples which want to purchase a qualifying home. They cannot have owned a home in Canada the previous 4 tax years, and the funds must have been in the RSP for 90 days. So no repayments are required in the year the house is purchased or the full first year after. And you must repay the loan or face tax consequences. Failure to make payments result in tax payable on that amount. So if you do not repay your loan for the home buyers plan, then in that case, you will need to pay taxes on it, on the amount that you do not deposit back to the RSP. For example, if you withdraw from the home buyer plan in 2013, by 2014 and next year, before October 1st, you must have bought the home. And in 2015, the year after, then there's 15 yearly payments start. So 1/15 of the amount you took out per year for the next 15 years. The second benefit of the RSP is that the money that you deposit in the RSP, you can use it to go back to school with a lifelong learning plan, the LLP. So you can use your RSP to fund your own or your spouse's education under the LLP. So you can withdraw $10,000 to $20,000 tax-free per year from your RSP. For example, Zoe decides to upgrade her education and study full-time for 2 years. She decides to borrow the maximum amount of $10,000 for 2 years from her RSP. So she has to pay back $20,000 over a period of no more than 10 years. If she misses a payment, that amount will be added to her income for that year, and she'll be taxed at her marginal tax rate. So this lifelong learning plan is $20,000 per spouse out of RSPs, $10,000 per year, and the repayment starts either the first year, not in school, or 5th year after withdrawal. And funds have to be in the RSP for 90 days or more. The third benefit of the RSP is you can split your income with a spousal RSP. This is a great way to reduce taxes. So you can contribute to the spousal RSP, either their own RSP or a spousal RSP. And the other way you can also split RSP income is after the age of 65. Or after the age of 65, you can receive income from your RSP through RIF account, and that payment can be split between the spouses. So if there's no income splitting, in this example, spouse A is earning 100,000 in retirement. They're at a very high tax bracket, and there's old age security clawback because they're over the threshold. Spouse B is earning $20,000 per annum, and so they are a low tax bracket. So it's better off if they're able to split. If there's 100 plus 20 is 120 divided by 2. If they're able to do 60,000 each, they will be at a lower tax bracket and no OAS clawback. So you can't just move the money over from A to B. There will be attribution rules. So the proper way to do this is through the spousal RSP and income splitting. So you can split. So one way of income splitting, like we mentioned, is spousal RSP contribution. The other is in retirement when they are getting a CPP pension, they can split the CPP pension also. So one spouse over age 65 can transfer pension income to the other up to 50% in the tax return. And also you can split lifetime annuity, RSP income, RSP annuity, and RIF income, as well as TPSP income. So let's take a look at this example here. In this example, Donald gets $24,300 as pension, and his tax rate is 37%. So Betty has a tax rate of 22%. So Donald is paying $24,300 times 37%. He's paying $8,991 as tax. So they can split half of it each when they do their taxes. $12,150 each they will claim. So 37% of that for Donald. So his tax bill is now going to be this amount, and Betty's tax bill is going to be on 22% is going to be this amount. So the total tax now is $7,168. And the saving is from this to this. The difference is a saving of $1,822.45. In the spousal RSP, let's take this look at this example. So the lower income spouse will contribute. The higher incomes will contribute to the lower income spouses spousal RSP. So Uzma contributed $10,000 to Abid's RSP. Uzma income is 120,000. Abid's income is 30,000. So Uzma will contribute 10,000. Suppose in 2015, 2016 also 10,000. In 2017 also 10,000. Now in 2018, they take out, or she takes out 23,000. There's 30,000 here in the RSP, spousal RSP. She takes out 23,000. So this 20,000 is tax payable by the contributor now, because this has not been in for 2 years complete. Should be a year of deposit plus 2 years. This one also has not been in for 2 years. So the tax is payable by Uzma. And the remaining 3,000 is tax payable by Abid. If they had waited longer, like 7,000 is taken out here, this will be taxed by Abid.